Something big just snapped in silver, and it happened fast. In less than 48 hours, silver dropped 37%. 37. That move erased roughly $1.4 trillion in paper value almost overnight, right after prices tagged the $120 area. And here's the part that makes this urgent right now. JPMorgan just came out warning silver could slide back toward $50 an ounce. That's roughly a 50% downside call, made after one of the most violent crashes we've seen in years. This matters for you because this wasn't random. It followed a very specific pattern. Stay with me, because I'm going to show you exactly what just happened, why it keeps repeating, and how you can spot it earlier next time. Before I explain what caused this drop, let me teach you something most people never really internalize about markets. Price doesn't move on belief alone. It moves on positioning, leverage, and liquidity. You can be right on the long-term story and still get crushed in the short term if the structure is wrong. Think of it like stacking bricks higher and higher on a narrow table. It looks impressive. Everyone admires it. But the taller it gets, the more fragile it becomes. Silver's 260% year-over-year rally did exactly that. It pulled in momentum traders, short-term speculators, and leveraged futures positions. And when you see price go vertical like that, you're not watching fundamentals improve in real time. You're watching leverage pile on. That's the part you always need to recognize. Now, when smart traders look at parabolic moves, they don't look at the headline price. They look at open interest in futures contracts. They look at margin debt. They look at how fast retail money is pouring in relative to institutional money stepping back. So what does that tell us? It tells us that velocity matters more than direction once things go parabolic. A rally that takes 6 months to build can unwind in 6 days, or in this case 2. The speed on the way up creates the speed on the way down. And if you're watching now, you're ahead of most people who'll only hear about this crash after it's already over. Your job is to understand the mechanics so you can see it coming next time, not just react after the damage is done. Here's what I want you to remember from this section. Market structure beats market story when volatility spikes. You could have the most compelling long-term thesis in the world. Maybe you believe in silver as a monetary metal. Maybe you see industrial demand rising. Maybe you think inflation's coming back. All of that can be true. But if the trade is overcrowded and overleveraged, none of that saves you from a 37% haircut in 2 days. That's the lesson. Write it down. Structure first, story second. If this is making sense, drop a comment below and let me know you're following along. Now here's what's actually happening under the hood. Let me break down the sequence because this is where people get lost. Silver rips higher. Futures traders pile in. Margin requirements start creeping up because exchanges see the volatility. At the same time, liquidity thins out because fewer real buyers are willing to chase at extreme prices. Then something small hits. It doesn't even matter what. A positioning report, a risk-off move, or just profit-taking. That small dip triggers margin calls. Forced selling begins. And once forced selling starts, price doesn't fall because people change their mind. It falls because they're not allowed to hold anymore. So let's walk through that chain step by step. When silver was climbing from $80 to $90, then $90 to $100, then pushing toward $120, each leg higher brought in new buyers. A lot of them weren't buying physical silver. They were buying futures contracts. They were using leverage, maybe 5 to 1. Maybe 10 to 1. That means for every dollar they put down, they controlled $5 or $10 worth of silver exposure. When price is rising, leverage is your best friend. You make 5 times or 10 times the gains. But when price reverses, leverage becomes your worst enemy. You lose 5 times or 10 times as fast. And here's the critical part. The exchange doesn't care about your conviction. They care about collateral. When your position moves against you, they issue a margin call. You either post more cash or they close your position. No debate, no extensions. Now layer on top of that, what happens to liquidity at extreme prices? When silver's at $50, you've got a deep pool of buyers and sellers. Institutional players, commercial hedgers, long-term stackers, all providing liquidity. But when silver's at 120, most of those players step back. They're not chasing. They're watching. So the bid-ask spread widens. Order books thin out. And when books are thin, it doesn't take much selling pressure to move price violently. A few large liquidations can cascade through a thin market and drop price 10 or 15% before finding support. That's exactly what happened here. The first wave of selling hit thin liquidity. Price gapped down. That triggered more margin calls, more forced selling. Price gapped again, and the cycle fed on itself. But here's the part that should make you nervous if you're not watching structure closely. None of that requires silver to be bad. It only requires silver to be crowded. When everyone's leaning the same direction, when leverage is high, when liquidity is thin, you've got all the ingredients for a violent unwind. The trigger doesn't even need to be fundamental. It just needs to be enough to start the first wave of forced selling. After that, the mechanics take over. Price feeds on itself on the way down, just like it fed on itself on the way up. Leverage plus speed equals fragility, every single time. Now let me show you what very few people are talking about. There's a secondary layer here that made this worse. As price dropped and volatility spiked, exchanges raised margin requirements again, mid-crash. So traders who survived the first wave of margin calls suddenly faced new collateral requirements on their remaining positions. That forced another round of selling. And because volatility was already elevated, those sales hit the market in an environment where everyone else was also trying to exit. No buyers stepped in because nobody wanted to catch a falling knife in a leveraged cascade. That's how you get a 37% collapse in 48 hours. It's not one thing. It's a sequence of things, each one amplifying the next. Forced selling triggers more forced selling. Volatility spikes trigger higher margins. Higher margins trigger more liquidations. It's a feedback loop. And once it starts, it runs until either price finds a level where cash buyers step in, or everyone who's going to get flushed out gets flushed out. That's the mechanism. That's what you just witnessed. Now zoom out for a second, because this isn't new. This is the exact same playbook silver ran in the late 1970s. Let me take you back there. In 1979 and early 1980, silver went on an absolute tear. It rallied from around $6 an ounce to over $50 an ounce in a matter of months. The Hunt brothers were accumulating, inflation fears were rampant, people were convinced silver was going to the moon. And then what happened? The exchanges changed margin requirements. Forced liquidations began. Silver crashed from $50 back down to below $10 over the next few months. A brutal 80% drawdown. And here's what's wild. That crash happened mid-cycle. The long-term bull market for silver and gold in that era wasn't over. It continued into the early 80s. But if you bought at $50 in 1980, you got absolutely destroyed. Same thing in 2011. Silver ran to just under $50, collapsed by about half, and wiped out late buyers who thought momentum was the same thing as safety. Let me tell you what happened in 2011 because the parallels are eerie. Silver started that year around $30. By late April, it hit $48. Retail investors were pouring in. You had commercials on TV talking about buying silver. Message boards were filled with people saying it was going to $100, $200. And then in early May, the bottom fell out. Silver dropped from 48 to 32 in a matter of days. That's a 33% crash. Sound familiar? It eventually bottomed around $26 a few months later, roughly a 45% drop from the peak. Same pattern. Parabolic rally, retail euphoria, leverage buildup, then a violent flush. And just like in 1980, the people who bought near the top thinking the rally would never end got crushed. Every time this setup appears, the story sounds bullish, the price looks unstoppable, and the risk hides in the plumbing. When you look at the pattern, you see it clearly. Parabolic moves don't end quietly, they end violently, not because the long-term story died, but because leverage has to be flushed. The fundamentals that drove silver higher might still be intact. Industrial demand might still be strong. Monetary concerns might still be valid, but none of that matters when the structure breaks. The market has to cleanse itself of excess positioning before it can build a sustainable rally again. That's the lesson from 1980. That's the lesson from 2011. And that's the lesson from right now. If you ignore structure, you will get hurt. I don't care how bullish your thesis is. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could JPMorgan be wrong? Absolutely. Could silver find support sooner and rip higher again? Of course it could. Markets don't follow scripts. And yes, there are always claims about manipulation, suppression, or paper versus physical. Maybe there's a massive short position that'll get squeezed. Maybe there's hidden demand that'll come in and support prices. Maybe this is all coordinated by big banks to shake out retail before the real move higher. I've heard all those arguments. Here's the thing though. It doesn't actually matter whether those conspiracy theories are true or false. Even if there is manipulation, even if there is suppression, even if the paper market doesn't reflect the physical market, none of that changes the mechanics of what just happened. You still had a leveraged cascade. You still had forced selling. You still had a 37% crash. Those debates about who's behind the curtain don't help you manage risk. What you can control is recognizing excess. When volatility explodes, when premiums expand, when leverage dominates price discovery, your job isn't to argue the narrative. It's to respect the mechanics. Focus on what price is telling you, not what you want it to say. That's how you survive these moves. You don't have to know every motive, you just have to read the tape. Could silver stabilize here and rally back? Sure. Could this be a healthy correction in a longer-term bull market? Maybe. But you need to see stabilization first. You need to see volatility contract. You need to see forced selling exhaust itself. Until then, trying to call the bottom is just guessing. And guessing with leverage in a volatile market is how people blow up accounts. So stay skeptical, stay open-minded. But don't confuse skepticism with ignoring risk. There are probably three types of people watching this right now. The first is already long silver and feeling that pit in your stomach. Maybe you bought in at 110, 115. Maybe you've been holding since 90 and you're watching your gains evaporate. If that's you, let me say this clearly. You're not stupid. You didn't miss something obvious. You just got caught in a leverage unwind. This happens to everyone at some point. The question now is, what do you do next? Your focus should be survival, not proving you were right, not waiting for price to come back to where you bought it. Ask yourself honestly, can you sit through another 20 or 30% move without being forced out? If the answer is no, you need to reduce size. I know that's hard to hear. I know it feels like capitulation. But getting stopped out at the worst possible moment, because you held too much size, is worse than taking a controlled loss now. Position sizing matters more than entry price when volatility is this high. Protect your capital first. Vindication second. The second type of person watching missed the rally and feels relieved, maybe even vindicated. You watched silver run from 60 to 120, and you stayed on the sidelines because it looked parabolic and dangerous. And now you're thinking, see, I was right. If that's you, don't get arrogant. These moments create opportunity, but only if you wait for stabilization. Chasing crashes is just as dangerous as chasing breakouts. You don't know where the bottom is yet. You don't know if forced selling is finished. Wait for price to prove it can breathe again. Wait for volatility to compress. Wait for some sign of demand coming back in. Then you can start building a position. But if you jump in right now, thinking you're catching the bottom, you might just be catching the next leg down. Patience beats prediction every single time. The third type is longer term and trying to learn. You're not in silver right now. You're watching this unfold, and you're trying to understand the pattern so you can apply it to the next market, the next asset, the next parabolic move. If that's you, this is where the edge is built. Study how fast gains compress into losses. Study how crowded trades unwind. Study the sequence of margin calls, liquidity drains, and forced selling. That pattern will serve you in every market you ever touch. Whether it's crypto, commodities, equities, it doesn't matter. The mechanics are universal. Leverage plus speed equals fragility. Structure beats story. Parabolic moves end violently. Learn those lessons now, and you'll be ahead of 90% of traders out there. The universal rule for all of you, regardless of where you stand, is this. Structure matters more than story when volatility spikes. You can have the best fundamental thesis in the world. But if the positioning is wrong, if leverage is too high, if liquidity is too thin, your thesis won't save you from a drawdown. Manage your risk first. Let the story play out second. So here's what I want you to answer in the comments. Where were you in this move? Were you long and watching your position collapse? Were you on the sidelines feeling relieved? Or are you just trying to learn the pattern? Let me know. I read every comment. So here's where I stand. I'm not panicking and I'm not blindly bullish. I'm cautious and patient. Let me tell you what I'm personally watching. First, I'm watching the $95 to $100 zone for stabilization. That's where emotion has to cool. If silver can hold above 100 and start building a base, that tells me the forced selling might be exhausting itself. If it slices through that level without any pause, that tells me there's more pain coming. Second, I'm watching the $70 to $80 area as a deeper deleveraging zone. If forced selling continues and we get down into the 70s, that's probably where you'll see long-term physical buyers step in. That's the level where fundamentals start to matter again. Third, I'm monitoring volatility and physical premiums. If volatility starts to contract instead of expand, that tells me the worst of the cascade is behind us. If physical premiums start to compress back toward normal levels, that tells me panic is fading. Those are my three watch points. Based on my analysis, this move was mechanical, not emotional. It was structural, not fundamental. The fundamentals didn't vanish in 48 hours. Industrial demand for silver didn't disappear. The monetary thesis didn't collapse. What happened was a leverage flush. The market was overcrowded, overleveraged, and fragile. It needed to cleanse itself. That's what these violent crashes do. They reset positioning, they flush out weak hands, they clear the deck for the next move, whatever that move ends up being. If history rhymes and silver can stabilize above $80 or $90, the move that follows could be significant. Not because I'm predicting it, but because that's what happened after the crashes in 1980 and 2011. The market flushed leverage, found a base, and eventually built another leg higher. I'm not saying that's guaranteed. I'm saying it's possible, but only after the excess is burned off, only after structure repairs itself. Trying to front-run that process is dangerous. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data. Look at the charts. Make your own decisions based on your own risk tolerance and your own timeline. What I'm giving you here is pattern recognition and market mechanics. What you do with that information is entirely up to you. If you made it this far, you're the kind of person who thinks critically and doesn't just react to headlines. That mentality will serve you well, not just in silver, in every market you ever trade. The people who survive and thrive long-term are the ones who respect structure, manage risk, and stay patient when everyone else is either panicking or chasing. You're building that skill set right now just by watching this and thinking through the mechanics. If this breakdown helped you understand what just happened, share this video with someone who's trying to make sense of the chaos. Hit subscribe if you want more breakdowns like this when the next major move happens, and stay ahead of the noise. Most people will only hear about this crash after it's over. You're hearing about it now. You're learning the pattern now. That's the edge. Use it wisely. Stay sharp out there. Think critically. Verify the data. And make your decisions, not the markets for you.